Good afternoon. My name is Donovan McLemore. I am a senior at the University of Memphis. I currently serve as a student ambassador here at U of M, and I'm extremely excited to welcome you all to our first Lunch with Leaders webinar presented by the Office of Advancement. Today's topic is maximizing your end-of-year charitable giving. This webinar will hopefully equip you to learn how to utilize qualified charitable deductions and other vehicles to maximize your charitable impact prior to the tax law changes coming in 2026. I have the distinct honor of introducing our hosts for today's webinar, Marty Kelman and Keith Schmitt. A two-time alumnus of U of M, Marty Kelman is a senior financial officer and the founding shareholder of Chairman and Kelman Lazaroff Incorporated. Marty is a CFP professional. He's a past president of the International Association for Financial Planning, the Memphis chapter. As the son of Holocaust survivors, Marty has served more than 20 years of international and local boards of Facing History and Ourselves, an initiative that teaches students how to remedy hatred and bigotry. He currently serves on the University of Memphis Alumni Board, the Jewish Community Partners, and served on the Unknown Child Foundation Board for Vitalent Partners and served as Unknown Community Leadership Council. Over the years, he has led Ridgeway Country Club, Leadership Memphis, and Alepsy Foundation, advised the Junior League, and chaired on the Shelby County and Memphis Youth Guidance Commission. Another two-time U of M alumnus is joining us today as well, Keith Schmitt. He is currently the Director of Financial Planning and Senior Financial Advisor and shareholder with Kelman Lazaroff Incorporated. As Managing Partner for Financial Planning at Kelman Lazaroff Incorporated, Keith leads and guides and coordinates the firm's financial planning, consulting, and strategic investing activities. Keith is a certified retirement counselor. Now, without further ado, I'll turn it over to Mr. Kelman and Mr. Schmitt. Thank you.
Thank you, Donovan. As you can see, University of Memphis has some great students. None of you would be here unless you were inclined to look at charitable giving as something that was important in your life. Most of you probably had to go through a lot of things yourself. I'm sure you have resilience and you want to give back. And that's what charitable giving is all about. There's so many different organizations that you can give to your charities, whether it be your churches or community organizations or educational institutions. The one that we're going to be highlighting a little bit today is the University of Memphis. That's a place that I feel if you have any desire to make the city of Memphis better, the University of Memphis has in so many ways can do that. Right now, the undergraduate enrollment at the university is about 35% for first-generation college students. If people like that can graduate and get back into our community, that alone will help the city too. Unfortunately, Memphis has a lot of poverty, and almost about a third of children are impoverished right now. So it's very needy, and the university has endeavored to do so many different things in that realm. They do things in the area of education to teach teachers, healthcare to deal with nurses, and they also provide a lot of research studies for the city and the county. Knowing some of the leadership at the university, they're always willing to pitch in whenever they can. I'm blessed also to be one of the founders of Kelman Lazaroff, a financial planning and investment advisory firm. Been around since 1979. We struggled mightily at the beginning trying to figure things out, but fortunately we were successful. And we now have 7 partners that do a great job of meeting with our clients with the purpose of getting to know as much as they can about each individual so that whatever the recommendations are that we provide to our clientele, it's as if we were making those same recommendations to ourselves. Fortunately, I'm with one of our partners, Keith Schmitt, who has been with the company for 18 years. He's going to lead the presentation and how to give to charities in a tax-effective strategy.
Thanks, Marty. I appreciate it, and I appreciate everybody who's on the meeting today. I hope you get some good information. It's an honor to be here. I was an alumni, got an undergrad from Memphis in business and a master's in business administration as well, and I was fortunate enough to have the honor of playing for the soccer team here. So this is near and dear to my heart, and I do enjoy supporting this university. Some of the things we're going to touch on today blend the lines of estate planning to tax planning, specifically year-end planning, that we're trying to focus on what y'all can do before the end of the year to really better yourself. So some of the things we're going to talk about are some of the tools and strategies we have. Also the latest and greatest One Big Beautiful Bill Act that was passed and that will have some impacts for year end as well as into future years that may bring some of your charitable giving forward for tax benefits and for other just planning purposes. We'll also touch on briefly some multi-year charitable planning and then just give you some resources. Obviously, there's some disclosures on the presentation that we've got to share with y'all. Kelman Lazaro, we're an investment advisory and financial planning services. We don't do tax or legal advice. However, we do provide tax planning and estate planning for our clients and work with our trusted professionals for our clients, which are anywhere from CPAs to estate planning attorneys, to help them kind of build a plan and structure. And we're going to let you glean a little bit of that information today. So let's transition to some actual tools and strategies. We find the use of case studies provides a higher level of understanding and just more relatability to what's going on in people's lives. We're going to touch on some giving strategies that maybe apply to higher income earners as well as people that just want to give a little bit every year, followed by some for some clients that might be a little bit on the older side and require minimum distribution planning. So the first thing is, let's talk about the what. When we talk about charitable giving, it's not to discount the benefit of donating your time to help an organization. That's very valuable. But what we're going to be focusing on today is the financial side of it. So cash. Cash is obviously, writing checks, credit card donations online. But what's a lot of time overlooked is the idea of giving appreciated securities. So that could be stocks, that could be mutual funds, ETFs, which are exchange traded funds. And what we're going to talk about is how do you give those? And the University of Memphis is equipped to be able to receive stock donations and other appreciated assets, which can help you in certain ways. There's a couple benefits to giving appreciated assets versus just, say, cash. You can give more with less, as in maybe you were fortunate enough to buy Amazon for cheap and now it's thousands of a percent higher. If you give that stock to an organization that's a charity, that's a 501c3 like the University of Memphis, they don't pay taxes on that. So the gains that you would have, you pass on to them and the tax just goes away. So it allows you to give a little bit more with less based on your successful investing over time. As an investment advisor, Kelman Lazaro, we like this for our clients that are charitably inclined, because if we do a good job for our clients investing their portfolios, you inevitably have gains. And those gains over time, like Marty said, we've been in business since 1979. So we've had some clients that have been investing with us for 30, 40 years. So those gains over time become a tax liability that when you sell them, you've got to pay Uncle Sam. And what this allows us to do when we look at giving things like appreciated securities, especially before year end, you can give those securities away, get the tax deduction you want, and then the money, the cash that you would have otherwise given, you can reinvest into your portfolio. And if you liked what you gave away, buy the same thing again. So it allows you to kind of cycle through very legally and within the IRS rules. And not to get political, I've yet to meet anybody who is hurtful of cutting Uncle Sam out of some tax revenue. So what we're trying to do is, within the IRS rules and guidelines, provide benefits to our clients as well as to the university to allow them to give more with less. Let's talk about a case study, because again, I think it's very helpful when you talk about actual process. And this one is just a simple process. And I realize that for some of you, $30,000 might be a lot of money. Or ideally, for some of you, it might be a little bit of money, and the university would love that as well. But you could do this over several years. But there's two scenarios. On the left side, you've got $30,000 in cash. You donate it, and you keep your appreciated securities, your investments. You're eligible to get a tax deduction on that gift. You would basically get the donation. You get the donation, the university would get it, spend it on what they need, and you would get a deduction. However, if you were to donate appreciated securities, you could donate that same $30,000 value, but maybe you originally invested 10. So you have a $20,000 gain in that security. So when I say securities, that's synonymous with stocks, mutual funds, exchange traded funds, whatever it is. And we have some, amazing companies in Memphis, whether it be FedEx, AutoZone, or IP, that have had large gains. So maybe you own some of those, or you're fortunate enough to be in some of these stocks that have really exploded recently with the AI boom, like NVIDIA. So you give that, and the university gets the same amount. They get the $30,000. They can sell it, and then what it allows you to do is not have to pay that gain that you would have otherwise had. And that tax then goes away, and you can take the cash you would have otherwise given and reinvest and buy the same stock again. The reason why I focused on the 30,000 and the reason why some of what we're talking about with this year end is the tax planning part of charitable giving has gotten a little more complicated. There's a standard deduction that is a beautiful thing. It's basically the IRS and the government saying that a certain amount of money will just give you a deduction off your taxes. But as that deduction gets higher, it somewhat makes it harder to itemize. So what we've done with some of our clients is we've looked at how can we lump and clump or pull some of those gifts further. I'll go into that later. The second part, and sorry to you young people in the room or in the meeting, but this one only applies to folks over 70 and a half. And I should have let Marty do this slide because he's more age appropriate, but I'll take it on. I think I can handle this. And we work with a lot of our clients. So
I'll try to help you in case you make a mistake.
That's right. So what this one allows you to do is, for those of you who don't know, when you turn 73, the government now, all that hard-earned work that you've done to save for retirement and put into pre-tax accounts like 401ks, IRAs, you have to start taking it out when you turn 73. And so when you turn 73, they tell you there's a calculation and it says you have to take a certain amount out. It's roughly around 3.5% to 4% the first year. In each year you get older, it gets a little bit more. But what they've allowed us to do as planners and just individuals, you can actually gift some of that required minimum distribution directly to a charity, like the University of Memphis. So take, for instance, you have to take $20,000 of a required minimum distribution before the end of the year. You can work with your organization where your custodian, where your IRA is held. It could be a Schwab, could be a Fidelity, could be a number of different financial institutions that help provide IRA and retirement planning services. But a lot of times you can request they send a check on your behalf, or you can even get checkbooks in some cases to handle what's called a QCD, or a Qualified Charitable Distribution. By doing that, though, to take the example of you got to take $20,000 before the end of the year, let's say you wanted to give $10,000, and because you don't need the money for whatever reason, you're fortunate enough that you don't want, or you're just worried about paying the taxes on it, because when that money comes out from the RMD, you have to pay taxes at whatever your tax bracket is now. So if you write that check, that QCD check to the University of Memphis or another qualified 501c3, what that does is if you write it for 10, now the IRS says, okay, we'll go in with you. We'll let you write that check for 10. The charity gets it for 10. They don't have to pay taxes on that money because they are a charity. And now you only have to take $10,000 out of your R&D. So it allows you to lower your tax benefit or your tax liability while also benefiting a charity. And it feels more like a tax credit than a deduction. Because normally what you would do is you would take that money out from your IRA, you'd pay taxes, and then you could use the cash to make charitable gifts, at which point you get a deduction. The problem is that process of taking it out of the IRA not only affects your income tax that most people know, but remember, I'm talking to people that are a little bit older, and so you're talking 70 and a half, 73 years old, you're already on Medicare. Medicare is means adjusted. So if you have a higher income, you actually pay a higher Medicare premium. So it serves as sort of a phantom tax. When you can say it's not a tax, but if I make more money and I have to owe more to the government, by definition, that's similar to a tax. So by doing this and gifting some of it away, it may allow you to lower your taxable income to where you're underneath some of those thresholds, which the The clever term they came up with was Irma. It was kind of funny a few years back when we had Hurricane Irma, and I was talking to clients in Florida saying, I'm worried about Irma, and they're like, we are too. And I'm like, it's not that Irma. I'm talking about the Medicare premiums that may go up because your income's too high. But what it allows you to do is benefit yourself now. And the other thing with regards to QCDs or qualified charitable distributions, you don't have to worry about itemization because they come out before you do your taxes. They just come straight out of money that has never been taxed in an IRA, and they go straight to a charity. So it's great. It allows you to overcome some of those thresholds when it comes to the standard deductions being almost 31,000, 30 plus thousand for a married couple, 15 for a single filer. And a lot of times when you're in your 70s, you don't have as many itemizations because you hopefully have paid off your mortgage, so you don't have mortgage interest. There's a lot of things that don't come into play that allows you to itemize. So the next thing is talking about.
Before you leave that, I'll just again, because I can add to this part of it, the qualified charitable distribution, it's really the bottom line that the way I look at it, for those of you who are lucky enough to be in a situation where you are required to take money out of your IRA, but you don't really need that to live on, and you want to give to charities, it's an absolutely perfect way, a great solution for you to save the most in taxes.
It is the best dollars. One of the few blanket statements I can say today is that for someone who's 73 and older, and they have the means to continue their lifestyle as is, and they don't need the money that could come out from a required minimum distribution, it is by far the best money to give away because it is more like a tax credit than a deduction. So while we've talked about giving appreciated securities, when our clients reach 73, we transition them into qualified charitable distributions from their IRAs.
So there's a lot of information that's already been disseminated, but I would ask for those who are listening in today, if it may not pertain to you, but it may pertain to somebody else that you know in your family or so forth, that I would certainly encourage you to spread this type of information to them too.
Yeah, it's surprisingly how many people don't know about this existing. And I know the cause, I'm good friends with a reverend, and his response to me is, my job is to make sure the people at my parish give, not to tell them how to give. That's your job. And so that's what we're trying to do today, is to talk to people that already give and that are already charitably inclined or philanthropic, and just make sure you're doing it as efficient as possible. If you have the means to do it, the next step is to just do it as best you possibly can within the rules the IRS sets forth. Some of these strategies that are a little bit more intense, and this slide, the strategies for charitable giving, probably not enough time to execute some of these before year end, but I just wanted to briefly share and kind of put a plug in, because we work with some clients that maybe, have helped, or their families don't need the money, or maybe they don't have children and they're looking for a way to give. And some of these that are on here, these additional strategies, whether it be a charitable lead trust, charitable remainder trust, endowments, foundations, scholarships, there's a lot of ways you can give and structure your giving to the university beyond just writing a check or going online and hitting the donate now. And you have a resource up here at the university that you can speak with, and they know if they have any complicated issues, they can always reach out to us and other alumni that provide and practice this day in, day out for other clients. We're happy to help and help coordinate that if it helps the university going forward. Let's shift over to what we're all still learning about, which is the One Big Beautiful Bill Act. We'll call it OBA for short. It sounds like a musical instrument, but it's not. It is definitely big. I think for CPAs and people like myself, I'm not sure if we'd call it beautiful. It's 1,000 pages to read through, but there is some really unique and good information in here that will lend itself to possibly accelerating giving before the end of the year. So I wanted to touch on a few of these items because they will impact you at year end, but there's also some thought process for what happens in 2026, 2027, and 2028 and beyond. And some of the items that are interesting that are going to happen right out of the gates is in 2026, they're going to have higher floors. And what I mean by that is all of your giving, what you are allowed to take as a deduction, the first 0.5% of that you're not going to really get. It's a floor. So part of the reason why I'm bringing that up is if you were planning on giving next year, because of this new floor and because of some other things, you may want to consider giving it this year before the end of the year. The other thing is the standard deduction this year went up. It jumped up to about $30,000+. And so that's something that, is a little bit higher to overcome, but there's a strategy that we'll discuss that may benefit you. The other thing is for those 65 and older, again, I'll take this, steal some of Marty's thunder here, but there's an enhanced deduction. So depending on what your income limits are, this was what the administration was talking about, trying to get deductions for Social Security. They didn't really do that. What they did was they gave a deduction for those that are Social Security age eligible. So there's an increased tax deduction. So, what we're bringing that up there is that your taxes, depending on how you fall this year, you may have a little bit more to give because you may actually save a little bit on taxes that you would otherwise owe this year. And maybe you want to consider giving some of that windfall to the university. The other thing that I think is really important to talk about that really starts next year, but there's going to be a cap. And again, this one I know does not apply to many, and the ones it does apply to, very fortunate, but they may fall in the highest tax bracket. So what's going to happen next year? We talked about the floor, but there's also going to be a cap. So if you are fortunate enough to earn a high income and fall in the 37% tax bracket next year, when you give a charitable donation, they're actually going to cap you. The IRS rules are going to cap you at 35%. So it's roughly a 2% hit. So what we're talking to some of our higher net worth clients and really not net worth, but high income earners, or people that may end up being in that in 26, 27, 28, and 29, is that they may want to consider, if they're fortunate enough to have the money, to do it now, to lead with it now. So that way they don't have the 2% reduction in the deduction. And so that's planning that we're working specifically with our clients. And if you have an advisor and you're fortunate enough to have that level of income, you definitely want to reach out to them and speak with them. What's also interesting next year, and hopefully the university benefits this greatly. So I've talked about QCDs, I've talked about appreciated securities, I've talked about some other increased or more complex strategies. Well, they're bringing kind of an oldie back that they had for the pandemic COVID. They gave it what's called an above the line or universal deduction. And what that means is you don't have to itemize to get it. So for a single filer next year, you can give $1,000 to a charitable organization and get the deduction whether you itemize or not. For married couple, it's $2,000. What this means, though, there is a little bit of catch. You cannot use appreciated securities for this deduction, and you cannot use QCDs, and you cannot use donor advised funds. It has to be a cash or cash-like gift. So that's writing a check, giving cash, or going online and using your credit card. That's fine as well. But everybody will be able to participate There's no income limits. There's nothing. It's $1,000 per person, $2,000 for a married couple. So again, going back to some of those old strategies, if you're going to impart on a qualified charitable distribution, utilizing what would otherwise be your required minimum distribution from your IRA, if you wanted to give $10,000 this year, that's fine. Next year, you could still give the $10,000, but what we would structure with our clients is you give 8 from the QCD and you give 2 from cash. That way you benefit both ways and take advantage of it. Or if you're fortunate enough, still give the 10 from the IRA and give an extra 2 in cash. So that way you reap the full benefit that the IRS allows you to have. So let's talk about some action items and some tips before year end. Again, one of the hurdles is the standard deduction. It's a huge benefit for people that were no longer itemizing. So for people that had paid off their mortgages or don't just have a lot of expenses they can itemize. So again, for a single filer, it's roughly $15,000. For a joint, it's roughly $30,000 for married jointly. And then you put on top of that, if you're over 65, you get even more deductions. So that's kind of all in the house. So when you give these charitable donations, what we do with clients is we consider establishing a donor advised fund. And what that means is, and this is not to say you don't give, if you want to give a large gift to the university, you can. But if you're planning on giving it over several years, you may want to consider this strategy where maybe you want to give, $5,000 a year for the next 6 years. Well, if you only gave $5,000, you didn't itemize, you don't really get that tax benefit per se because the standard deduction kind of eats into it. It's on the house. But what you can do is consider maybe you have, sales tax, and you have property taxes, and you have some interest, and then you could stack, and if you're fortunate enough to have it, you could give $30,000 now to a donor advised fund, immediately give the university the $5,000 you wanted to give them this year. But when you fund the donor advised fund, the year in which you fund it or contribute to it, you get the tax deduction. So what you're doing is you're pulling future giving into the present, so you get an elevated tax deduction, and then going into next year, you would just take the standard deduction, standard deduction, standard deduction. So they call this a strategy a lump and clump. So you're kind of lumping and clumping all of your charitable donations into 1 year, so you get an elevated tax deduction, and then you fall back into just the normal, I'll just take the standard deduction. And then once you go through your donor advised fund, you do it again. So you rinse, wash, and repeat. And sometimes for some clients, it may be 3 years worth of giving as the trigger, and it may take 5 years worth of giving. But it's a great strategy that we recommend to our clients, and you do have time to do this before the end of the year. So it's something that we would definitely recommend to folks and clients. And I realize that I'm giving broad strategies. Make sure you're discussing this with the professionals you rely on, your planners, your CPAs, to make sure they're good fits for you. We spend a lot of time getting to know our clients and how, what keeps them up at night, their hopes, their fears, their dreams, to make sure we customize and tailor our recommendations based on their needs, not just blanket statements, because there aren't many blankets that fit everybody.
Keith, you might want to identify some of the places that some of our clients, you get their donor advised funds from.
Yeah, so there was an earlier slide that's in the deck that, we've worked with everybody from the Community Foundation of Greater Memphis, which is a great resource for local charities. They specialize in giving to local charities. They can also help give to national charities. They don't discriminate in that way, but they're just great at supporting local charities, as is the Christian Community Foundation, the Memphis Jewish Foundation, and then it's Schwab Charitable and Fidelity Charitable are also extremely large donor advised fund providers. I think Schwab just recently changed to DAF, which stands for Donor Advised Fund Giving 360. But those are institutions that are basically charities that help you navigate through this, and they provide a lot of resources on their websites for how to give and how to give efficiently. The second thing I wanted to talk about again is those who are subject to required minimum distributions, or RMDs. If you consider giving before the end of the year, it helps reduce your taxable income, and it can cover basically the IRS says, we'll let you give all of your required minimum distribution away to charity if you want, if you don't want to be taxed on any of it. And remember, this is when maybe those that are 73, maybe they were earning and working their tail off, and they were able to deduct this income tax prior, maybe at a 30% rate. So this money that you're giving to charity, if you're giving $10,000, originally maybe it only cost you $7,000. So that if you look at the $10,000, if you took it out, you'd only get $7,000 because you owe taxes on that. So this is a great way to give more with less. And there is a cap, and I hope there's someone on this call that can reach the cap, but it's $108,000 that you can give from an IRA per year. That's the cap, but you can give all of that, and that may be more than your required minimum distribution, but in some cases that's still the right thing, because by taking money out of your IRA, it lowers your future required minimum distributions because there'll be less in there. A required minimum distribution is calculated every year. It takes the prior year-end values of 12/31 and provides a factor based on your age. And then that tells you what you've got to take out. In layman's terms, it would be 4% or 4.5% or 5%. The older you get, the more the government makes you take it out, because that money's never been taxed and they want to get it back into the economy and back into society. And obviously they want the tax revenue.
You might want to talk about even, there may be nobody in the call that can do more than the required minimum distribution. But if you're going to prioritize who you want to leave to your beneficiaries because of the high taxation of IRA.
That's a great point. So a lot of times we work with estate planning attorneys, and we'll see in trusts or wills that people have for their families bequests. And those bequests will just say generically, I want to leave the university $50,000, and they don't necessarily stress where it comes from. what we do with our clients is get them to think about the buckets of money they have. If I talk to most anybody and I said, wouldn't you rather have one account? They'd all say yes. But the reason why you have multiple accounts is because they're taxed differently. And so based on how they're taxed, some of them lend themselves being better to be left to individuals, family members, children, friends, individuals that would have to pay taxes, versus others lend themselves being better to be left to organizations that don't pay taxes, like the University of Memphis or other charities. So take, for example, an IRA. You've worked your whole life and maybe you want to leave that $50,000 gift. You're probably better off setting up a beneficiary on your IRA, your individual retirement account, to list or name the University of Memphis. And there's folks here at the university that can help you with titling and help you with the process for doing that. But it allows you to leave money that's never been taxed to an organization that will never be taxed. So you get a lot of synergies there. And again, I apologize for anybody that thinks Uncle Sam's not getting his fair due, but I've yet to meet you. So, it's just something that we consider for our clients. And it's a great way to put some of your hard-earned years of work and make them more efficient when you do want to give them. The third thing, and again, this is more for those who are blessed enough or work hard enough to earn and have high income rates, but those who expect to be in the 37% bracket, whether it's next year or let's just think, you're hoping that you get a promotion or something's going to pay off or hit, or your business is going to take off, or you're going to sell a business. In any of the next 3 or 4 years, you could fall in the 37% bracket. You may want to consider making a gift early, because the cap will be in place in 2026 and beyond. I think until 2029 or 2030, to where if you're in the 37% tax bracket, you're only going to get a deduction of 35%. So that's just something for year end. Again, multi-year charitable planning, I want to touch on some of that. And this is, not everybody can predict the future, but you can make educated guesses that could be guided by a strong team of professionals like financial planners, estate planners, or CPAs. You can also consult with the University of Memphis and any other organizations you feel strongly about and develop the planned giving strategy that can effectively achieve your giving goals. The reality is, people want to give, and there's always this fearful, will I have enough? Am I giving too much? And that's where you really need to plan, and you need to sit down with folks that can help guide you through what could be, because it's hard in planning. A lot of it is planning for the worst and hoping for the best. When I sit down with a new client, I apologize on the front end and I tell them, I'm going to kill you, I'm going to disable you, I'm going to do a lot of bad things for you, so that way we plan for them. And if I hope it never happens, but if it does, we've at least covered it, and your family and loved ones will have a plan, so it's not a scavenger hunt, it's not a process to where they have time to mourn versus picking up the, rubble and dust and trying to sort their way through it. I think teaming up with a financial, I believe wholeheartedly in planning and also receiving advice in anything I do. Life is very subjective. You fall into these traps of being busy and also coming up with the idea that if it's my idea, I always think it's the best idea. But when you share it with someone that you trust that can advise you, they have a little more objectivity, and maybe they can play devil's advocate or make a suggestion that brings some air to the conversation, and you realize maybe your idea was starting to be good, but maybe it fell short somewhere. So surround yourself with smart people, surround yourself with professionals and advisors that can help you change and evolve your plan as your life changes. I wanted to open it for questions. If we don't have any, what I wanted to do is just share a couple real quick. Giving cash or using credit card are the easiest way for me to give. Why should I do anything different? The answer is you don't have to. What we're talking about today is efficiency. You can continue to do exactly what you're doing. If you're giving, that's the most important thing. But you may want to consider, if you do have a position that maybe has a lot of gains in it, like a stock, and you've wanted to sell it, but you don't want to pay the taxes, if you were otherwise going to give that amount in cash to the university or another charitable entity, you may want to consider giving the security, and just some of those strategies that provide efficiency. So let's talk about this. I don't have an IRA. Can I make a qualified charitable distribution or QCD from my 401k or 403b? they're synonymous. One's just usually associated with, churches or universities or other organizations versus 401ks and more corporations. The answer is you can't do it. You can do what's called an in-service or a partial rollover. If you are still working, you want to keep it there, and you're just, you don't want to retire like this guy over here who's still working. So what you can do is do a partial rollover from a 401k to an IRA and then give from the IRA. So there are ways to do this that, maybe take an extra step or two, but it can provide efficiency for you and your family. If I usually take the standard deduction, how can I donate and still receive a tax benefit? Well, that's where we talked about the lump and clump. That's where we talked about pulling future years into the present, to where hopefully when you start tackling mortgage interest, property taxes, sales taxes, plus your donations, you can exceed that standard deduction and go from there. And then lastly, do I need to distribute funds from my donor advised fund? So as in, you've given to a donor advised fund, do they have to leave? No. The donor advised fund is a charity. So what it allows you to do is get the deduction in the year you want it to from a tax standpoint, but you can actually wait to give that money into the next year, whether it be 2026, 2027. There's no real deadline. So I wanted to touch on those as commonly asked questions. Are there any questions you want to share with me from the?
Yeah, thank you. Thank you, Keith, for sharing that knowledge. And Marty, yes, we do have a couple of questions. So if a donor was to establish a donor advised fund, are they able to then decide which charitable organizations receive those funds?
Great question. The answer is yes. A lot of those organizations I referenced earlier, whether it be Schwab, the Community Foundation of Greater Memphis, or the Community Foundation, is usually in almost any major city in the country. So if you're in Nashville, there's one in Nashville, or I think they call it Middle Tennessee. But those organizations usually have tens of thousands of pre-approved charities. If they don't have the charity you want, usually you just have to get the 501c3, a contact, and an address, and they get approval on it. And then you can give it from that donor advised fund to that organization in whatever year you want it. And when that organization receives it, the benefit is they receive a check. So there's some organizations or institutions, unlike the University of Memphis, that aren't tailored. It could be a small church that aren't tailored to receive appreciated securities. A donor advised fund is a great way to circumvent, there's, I don't want to call them shortcomings, but their lack of ability to receive appreciated assets, because you can give those to your donor advised fund and then just write a check from that. And you can carry that forward. So you could fund a donor advised fund this year for $50,000, and then your plan could be to give $10,000 the next 5 years.
But you only get the deduction in that one.
In the first year, that's right.
And what happens to those funds while they're sitting in the donor advised fund?
Another great question. So donor advised funds are by nature an investment vehicle. So for our clients, what we do is, depending on how long the goal is for the donor advised fund's existence. So let's say you're funding one this year and your plan is to give the bulk of the money out next year, the year after. While you can invest it, and they have, a litany of different investment choices, to where you can be aggressive, you can be conservative, you can put it in cash-like investments like a money market fund. We would typically say match the time horizon with the risk tolerance. So as in, the shorter the time horizon, the less risk you could take. So you don't want to fund a gift this year that you're giving next year, and God forbid the markets go down and you don't have the money in the donor advised fund, because you don't get those losses. Once you fund the donor advised fund, it is no longer your money. It is charity's money. A lot of times when you set up donor advised funds, you have to either set up a successor trustee, as in the person, if you die, who will continue to give the money, or you have to name a charity as the beneficiary. And that charity could be the University of Memphis. So as in, you want to fund gifts for the next 5 years, but you meet an unfortunate demise, that money will then be passed to that organization quicker.
Great, thank you. We have a question about, you mentioned both ages of 70 and a half and 73. Could you restate the difference between those two ages? So
this is one of those quirky things that the IRS comes up with, ages and guidelines. 70 and a half used to be the year you had to take a required minimum distribution. The Secure Act, I don't know if it was 1.0 or 2.0, changed that and moved it back to 73. And spoiler alert, I think they're trying to push it back to 75, but I don't know when that will happen exactly. But what they didn't do, they didn't move the age of when you can start making qualified charitable distributions. That still remains at 70 and a half. Now, the difference in the vagueness of should I or shouldn't I wait, if you give it at 70 and a half, it's not offsetting a required minimum distribution. It is lowering the amount you have in pre-tax money in an IRA, so that could be beneficial down the road, but it's not directly offsetting a required minimum distribution like if you wait till 73. Now, what I'll go into, and this is something that we work a lot with clients, if you're a married couple and you have a large amount of money in IRAs and you've saved your whole life, one of the things we bring up, and it's not a good thing, but it's called the widow's penalty. And what it means is, while you're married and you take that money out of an IRA and you're married, you're paying taxes as a married couple. But if one of you dies, or I should say when one of you dies, the survivor usually keeps all of that money that's in IRAs, except now when they have to take it out, they're paying taxes as a single filer. So a lot of times when we meet with widows and widowers, the next year they'll be like, what did y'all do? My taxes went up. And I'm like, nothing, we didn't do anything. You just now file as a single filer versus a joint filer. So in some cases, for those that are 70 and a half and maybe are not in the best of health, or they're worried they're fighting a terminal illness, and they want to make gifts, it might be a good thing to start giving early so they draw that balance down so the survivor doesn't have as much, which sounds weird. Normally you want the survivor to have as much money as possible, but not if it's going to create a tax burden. Because again, certainties, death and taxes, right? That's the saying. It's certain that those taxes will be paid, whether it's by the spouse or beneficiaries or survivors. The only way you can meet that is if the survivor or the beneficiary of it is the University of Memphis or another charitable organization.
But the tax burden that you mentioned really turns out to be a formula based on the required minimum distribution, which you have to take out. It's the amount of dollars that you have at the end of the year times some factor based upon your age. And all you're saying is to have to take less RMD out in the future, lower your balances, but shifting that money out for QCDs sooner.
That's right. And again, the cap there is 108,000. So you can give up to 108,000 because a lot of times the required minimum distribution for someone may be 40,000. But I have some clients that give all of it away, and I have some clients that can't give any of it away because they need to live off of it. So again, this is not a value judge. This is just us basically trying to provide information that may benefit some of you from a tax planning standpoint.
Great. How would a donor initiate a QCD to the University of Memphis?
Great question. So again, most organizations that are custodians of IRAs, individual retirement accounts, provide some kind of process. So again, I mentioned Fidelity or Schwab. They're some of the larger custodians in the country. But even like Raymond James, Pershing, there's plenty. I can't even, there's so many I can't go through them all. But a lot of times you reach out to your advisor. If you don't have an advisor, you can call directly to your service team and say that you would like to initiate a qualified charitable distribution. Some of them know QCDs, but it's always best to say it out loud, the full thing, so you get the right person helping you. And then what you can do in some cases is fill a form out. The form then requires the 501c3 of the charity you want to give. So the university has one, and people here can share that with you. And then the address at which you want to send it to, and maybe a contact person. And a lot of times that custodian will then send the check for you. The most important thing to remember or realize with regard to qualified charitable distributions, when you're trying to offset a required minimum distribution, is that your required minimum distribution is due by the end of the year. So if you write a check in now and the check isn't cashed until January, you've got a problem. You've got to make sure that the check is cashed and received and deposited by the charity in the year you want it to offset the required minimum distribution. So I hope that helps.
And what has happened in the past, a check will be mailed from the institution. It'll go to the charity, and it'll sit on somebody's desk after 12/31. And that, since you just want to make sure it gets
Not
cashed.
at U of M.
That's right. That's good.
That's why we always say send it to U of M. They won't do
We
that.
had to educate a charity that we did this fortunately in February, and they sent a lovely thank you letter to our client saying thank you for the donation, and we kept saying it hasn't cleared, the check hasn't cleared. And by May we put a stop payment, and then by June they got the check and deposited it, and they realized that their process should be to not send the letter out until the check is cashed. So That wasn't.
Okay, so I think we have time for one more question. Is it important with the QCD that the funds go directly from the IRA to the charitable organization?
Most definitely. If you take the funds out and pay yourself, that is a taxable event. That money needs to go directly from the IRA to a charitable organization, a 501c3. So whether that's, some of these organizations like Fidelity and Schwab, they'll actually issue you a checkbook that is tied to your IRA. And so you can make the funds available in your IRA. This is what we do with our clients. We meet with them typically at the beginning of the year, but they say, I want to give 10,000. We make 10,000 available. And then they let us know, hey, I'm writing a $2,000 check to this. I'm writing a $3,000 check to this. And we then make sure the checks are cleared through their IRA.
Great. Well, thank you, Marty and Keith, for sharing your time and knowledge with us today. Thanks to everyone who joined us online. A recording of the webinar will be available on our website, and we look forward to seeing you for our next Lunch with Leaders webinar.